Good morning, Market Chameleons, and everyone joining us for this first time. Thanks for coming by and checking out the Market Chameleon pre-market webinar. Market Chameleon, myself, Dimitri, are registered investment advisors or a broker-dealer. If you're searching for investment advice, please reach out to a licensed professional. This webinar, as all our webinar and shows, is for informational purposes only concerning Market Chameleon's tools and products. With that, one last look, and welcome to the stage, Dimitri Pargamonic. How you doing, D?
Good morning, Will. How are you?
Good. So what are we going to be looking at today? Something about risk reversals, right?
Yeah. So we'll cover a benchmark that tracks the cost of a risk reversal. And let me share my screen here so we can look at examples. Let me know, Will, if you see my screen.
It's there and up now, D.
Okay. So first, just to get to this page that we're going to discuss, I'm going to show you how to do that, and then we'll look at the page together and discuss what is a risk reversal, what benefits do we have tracking the cost of it, and what type of insights can we get from tracking the cost of the risk reversal, how you could use it as a potential trading strategy in your overall options trading. So let's first go to a symbol. We'll look at SPY in our example. So I'm going to type in SPY in the search box, click enter, and then on the left-hand side, we get this menu bar. Click on options, scroll down and look at strategy benchmarks. Okay, once you click on that, you're going to come to this page and you see different option strategies on top, and you could tap through them. We're going to click on risk reversal over here. And then I'm going to close this menu to expand our screen. And let's first cover what is a risk reversal strategy. And then we will look at the cost of it, the benchmark, and compare that to historical values, make some other comparisons. So when we look at a option risk reversal, it involves two different options on the same expiration. One is a upside call and one is a downside put. And you could do it, you could be on either side of that trade, buying an upside call or selling a downside put, or buying a downside put, selling an upside call. We're going to look at it from the perspective of buying an upside call, selling a downside put, because you have to pick a side to evaluate the cost. But obviously, you'll see what the cost is and the risks on the reverse side of that. So let's look at this graph here, and it helps us kind of visualize this strategy. If the stock price is right here in the middle in this gray area, and you buy an upside call, let's say with a strike of B somewhere above the current stock price, and you sell, buy call strike B, and you sell a put strike A, then at expiration, your payout would look something like this. If the stock goes up, right, and it goes above your call strike right here, B, well, what happens is you're long the stock at that strike, at that price. So if you own a stock, let's say at a price 110, and the stock continues to go higher, well, that will be beneficial for you, right? Something that you own at one price is going above that price, it's appreciating, well, that will show up as a profit. Now, to the downside, if you're short a put, right, you sold strike A, a put. Well, if the stock continues to go below that strike, well, what happens if you're short a put at expiration? That put, you get stock put to you at that strike price. So you bought the stock, whatever, let's say at $90. Well, if you buy it at $90 and the stock is 85, 80 or below, well, now it's worth less than the price you paid. So that shows up as a loss. Okay, so that's why to the downside, it'll show up as a loss. Now, this gray area here is in between the strikes. And here, the reason it's gray is that anywhere between strike A and strike B, if the stock expires in between those prices, let's say you have a put at 90 and a call at 110, and the stock expires somewhere in between 90 and 110, let's say 100. Well, the put will be worthless, it's out of the money. The call will be worthless, it's out of the money. So the profit or loss will depend on what you paid for that strategy. If you received a credit, well, then it'll result in a profit because you received a credit, both options are worthless, that becomes your profit. If you paid something for it, a debit, let's say you paid $1 for it, if they're both worthless, you lost that dollar. So in this gray area here, it will depend on the cost of the strategy. Okay, if it's a credit, it'll look green. If it's a debit, it'll look red. So that's the risk reversal strategy, what it looks like visually or graphically at expiration. And as you could see, if you're doing this, the side that we're showing, the legs buying a call, selling a put, then it is a bullish outlook. Okay. And a bearish outlook would be the reverse of that, buying the put, selling the call. And a couple insights we could get from the cost of this. If we create a benchmark, okay, that we could track every day, we could see if it's the cost of it is going up or down, or what is it currently relative to historical values. And to do that, we'd have to do a benchmark. First, we'd have to look at certain days to maturity. Okay. So here we use a 30-day constant maturity option. The reason behind is if we look at an option expiration and we track that option expiration, well, every day that option expiration gets closer and closer to expiration. Even if you start out at 30 days, the next day it's 29 days, the next day it's 28, then 27. So as you get closer to expiration, the dynamics and the options change. Eventually they just expire worthless or in the money or worthless. So we need to somehow track something that every day has a 30-day constant maturity or whatever day constant maturity. And to do that, we'd have to create a benchmark using the surrounding data formula similar to the VIX, because we don't have an option listed every day for 30 days or 29 days or 28. They don't get listed like that. So we have to create a benchmark that has a 30-day constant maturity. On top of that, we have to pick strikes based on their distance away from the spot price to normalize that benchmark to make sure that we're always comparing the same strategy. And let's say if for this example, we pick strikes that are 5% above that, a call 5% above that, the money, 5% below. Well, the other issue is that we're not going to always find an exact strike 5% above or 5% below. Strikes don't get listed that way. So we would have to create a weighted average formula that interpolates based on what the options, how they're listed, the surrounding options. What would a 5% call or 5% put below that the money would cost. So create this benchmark using the methodology and formula, and then we convert that to the cost. So the idea there is, how much would it cost to buy the call relative to selling out of the money put? Buying it out of the money call 5% above, selling it out of the money put 5% above, below. So if they're both exactly the same price, let's say you had a stock $100 and you looked at a $105 call, and then you looked at a 95 strike put. Well, if they're both $1, if the call is $1 and the put is $1, well, then that strategy, buying the call for $1, selling the put for $1, the cost would be zero, right? They would both offset. You would finance the price of buying the call by selling the put, with this type of risk profile. If the call was $1.50 and the put was $1, well, it cost you 50 cents because you paid $1.50 for the call. You sold the put for $1. That would cost you 50 cents. Or on the other side, if you bought the call for $1 and sold the put for $1.50, well, you would have gotten a credit. So the cost would be a credit to you. Somebody would have paid you for this risk profile. So that's what we're measuring. Not only the cost of the strategy, but it's going to give us an idea of the skew, the relative premium markets are pricing a downside put relative to an upside call that's the equal distance away from the spot price from the at the money. And that could also give us some kind of insights. Are markets, traders demanding put premium over call premium? By how much? Or is it fairly even? Or are they going in and demanding call premium, upside calls, at a higher demand than the puts? Okay, so we're going to get those insights just from looking at that risk reversal and how it's priced. So let's take a look at the current SPY risk reversal. So this is a 30-day constant maturity risk reversal that is looking at a 5% out of the money call and selling a 5% out of the money put. And how much would that cost us? Okay, in theory. And here, this is saying that this would get a credit of 0.4%. So we convert it to percentage because the stock is moving around, right? So the option values are adjusting to the stock price as well. So what this negative 0.4% means is that for like $1,000 worth of notional in stock, you get a credit of $40, right? That's kind of like the wait, did I do that? Or $4, right? That would be the credit that you would receive. Okay. So how does that compare to history? Right? How does that compare to the historical values? so that we would have to look back in time and look where was the average price, the average cost of this strategy. And here you can see that it is negative 0.2%. So on average, you do get a credit. The puts traded at a higher price than the calls. So there are two things, by the way, that could make that happen with options. One is the cost of carry component, and the other is the skew and implied volatility. Okay, so that's important to understand. There is a cost of carry component that could make the calls more valuable than the puts, where the puts more valuable than the calls. And then there's also the skew based on implied volatility. Okay, so if like interest rates are very high, call prices will be worth more than put prices, just because you could substitute buying a call instead of buying the stock, right? So because buying the stock involves putting up cash, right, that you're earning interest on. So if you're earning a lot of interest on your cash in the bank, let's say 5%, 10%, well, instead of buying the stock, you could buy the call, because you're earning all this money in interest. So the call will reflect that. It will go up in value. So from a historical perspective, we see that we get more credit right now than in the last 52 weeks. Okay, people are willing to pay a little bit more than usual for the puts relative to the calls. And when we look at this chart here, you see it pointing down. Well, it's pointing down because you're getting more credit, right? So going up, it would be, it would go above zero. The cost of it could be positive. You could pay a debit. Here we're getting a credit on the 30-day. And this dotted line here shows us the average for the last 52 weeks. So this lets us kind of see how far away the cost fluctuates around the average. If it stays very close to the average, usually then we would see these daily values very close. If they fluctuate a lot around the average, then we would see big spikes above and below. So here what we see is that the spikes actually are to the put. Okay, so but it does stay above this average for longer periods, which kind of makes sense, where the put, people are buying the put relative to the call to protect positions in times of uncertainty. But the times of uncertainty are usually get repriced quicker, right? This to the downside than times where things are more normal and the stock tends to either stay stable or float up. So this gives us an idea, even in the last 52 weeks, where those extreme values were, which looks like around around 0.6%. So we're at 0.4% right now, but just looking at it eyeball, let me try to hover over it here. I think this is like 0.5%. This one was it's hard to get it right on the tip. I think 0.6%. So we're closer to that more extreme level, right? Than we are to the average. That's what it looks like here, like halfway through. We could also look at that same benchmark, different expirations. What if we went out a little bit further? Instead of 30 days, 60 days, right? So if we go from 30 days to 60 days, we could see that here, the risk reversal would bring in a credit of 0.3%, right, relative to 0.2%. So you're getting more credit here than you are here. And if we went out 90 days, we're getting a credit of 0.2% versus a credit on average of 0.1%. So here, since we're getting more credit, what it's saying here is that the markets are anticipating more uncertainty right now in the shorter term, well, 30 days, to the downside. But it doesn't appear, just based on these, that in the longer term, it seems like the markets thinks it will eventually recover those losses. So that's kind of the insights, because we don't see these, as skewed as this 30-day. Okay, so 60-day and 90-day are not as skewed as much as that 30-day, which is shorter term. So the other insight we could get is on the day, how is it looking? So if we compared this benchmark from the previous day, is it going up or down? So here, this one went negative 0.1%. So the skew got a little bit bigger towards the credit side, right? While this one kind of went back up. So really quickly, what this does is allows us to look at a certain option strategy and how that's being priced in the market. It's also given us an indication, if we wanted to do this strategy, what would be the cost of it now relative to history, and what are the markets signaling based on this strategy. So similarly, like where we monitor the implied volatility, well, the implied volatility gives us a certain indication, right? The relative premium of option prices, the expected volatility moving forward. This gives us a little bit of a different viewpoint of the skew, the relative cost of an upside call to a downside put. So, I'm going to stop right there. I think we covered this risk reversal for today.
Yeah, that was great, D. Thank you so much. And we do have a webinar with IBKR this afternoon. You have to be on their site to go to the webinar and register. Even if you can't make it, you can get it sent to you by registering. So, and that's analyzing open interest, or
yeah, that's right. Well, we're going to discuss open interest today at 2 p.m. With Interactive Brokers. So you do have to register because they're hosting it on their platform.
And I just dropped the link into the chat. So great job, D, as always, bringing excellent information into these volatile markets right now. Everyone's talking about the volatility that's going on in the marketplace. So lots of great information as always. Everyone have a safe trading day out there. D, have a great morning, and I'll see you at 2, buddy.
Yep. Thanks, Will.
All right.
Bye.
Have a great day, everyone. Bye-bye.